Hello friends, welcome to JK Shah classes, starting with the new chapter revision of buyback tax or tax on distributed income upon buyback of shares by domestic company. It's a big name. To cut it short, BBT, buyback tax, chapter 12 DA. 3 sections, 115 QA, QB, QC and rule 40 BB. This chapter is no more applicable with effect from 1st October 2024. So May 25 and November 25 will be the last attempt for institute to ask a question on. This chapter is however applicable till 30th September 2024. As the name indicates, chapter will apply only to companies. Tax on buyback of shares. Who can buy back? Only company can buy back. According to this chapter, whenever company offers buyback, as per Companies Act, company cannot buy back more than 25% of the shares at a time in any 1 year. Whenever company buys back the shares, the extra amount which company pays to the shareholder above and over what company had received from the shareholder, originally received, that much amount will be called as distributed income, and this tax will be levied on that. The rate of tax for this chapter is 20%, 20% plus compulsory surcharge at the rate of 12%, and plus compulsory health and education cess at the rate of 4%. Health and education cess is always compulsory. Effective rate will be 23.296%. So 115 QA, 23.296% tax applicable. Company will have to pay this tax, and this tax will be called as income tax only. It is called as additional income tax. An additional income tax, that means this chapter or this tax is part and parcel of income tax. Tomorrow onwards, whenever we talk about income tax, we are talking about this tax also. On what amount? The amount on which this is leviable is to be called as distributed income. Stupid name is given. Left hand side bracket minus right hand side bracket. Left hand side bracket says amount received, amount paid by company, consideration paid by company for buyback, minus amount which was received by company for issue of such shares. Amount paid by company minus amount received by company. Simple language, for example, company is buying back its shares for 700 rupees per share, minus company had issued such shares at 100 rupee, face value 100 rupee, no premium, no discount, then the difference is 600 rupees per share. 600 will be called as distributed income, and on this 600 company will be liable to pay 23.296%. Then this tax is to be deposited within 14 days with central government, 14 days from the date of payment to the shareholder. Within 14 days to be deposited. If not deposited, there will be two consequences. Number one, from 15th day onwards, there will be interest charged at the rate of 1% per month or a part of a month, starting from 15th day from the date of payment to shareholder until the date of depositing to central government. And 115 QC says that if not deposited within the time or beyond time with interest, then company as well as principal officer of that company, both will be considered as a defaulter. Both will be deemed to be in default. Means both will be declared, company and principal officer of that company which has defaulted, both will be declared as defaulter. And once a person is declared as a defaulter, necessary recovery proceedings can be initiated against such people. Their personal bank accounts can be freezed, movable, immovable property can be attached, etc. Second point says that buyback tax to be deposited within 14 days, that we are done with. Next point, third point here is no credit or no deduction will be allowed to the company. So though this is additional income tax as we discussed, then also credit will not be given for this tax neither to the shareholder, because this is not TDS by company, nor will the credit be given to the company because this is not advance tax by the company. And this tax cannot be adjusted against normal tax payable by the company. No deduction, no credit, nothing. Not even deduction, this cannot even be called as an expenditure for the company. And once company pays this buyback tax, according to 1034A, shareholder will be exempted from the income that he generates, whether it is capital gain, long term or short term, or it is PGBP income in case he is a trader. Come what may be, shareholder will not be liable to pay any tax in case if company has paid the buyback tax. Okay, and then this chapter was introduced few years back only, and now it is deleted also. Before we proceed further, what kind of question can come in the exam? Because chapter is applicable till 30th September 2024. So if institute wants to ask a question, this would be the last 2 attempts. That's why institute may ask a question. It's a small chapter. Let's finish revising it. Now, most important part of this chapter is not this, that how much company is paying. Most important part is how much company had received. So you will say a company had received, what's so difficult in that? Answer, the only difficulty is that for different types of shares or different classes of shares, company might have received different amount. If company has received or company has issued shares at par, then company must have received 100. From some people, company received 100. Thereafter, company came out with follow-on offer. Company offered another lot of shares at 120 rupees by charging 20 rupees premium. Then maybe in future company allotted shares or issued shares at 80 rupees, that is 20 rupees discount. Then company might have come out with right shares, company might have issued bonus shares, company might have got amalgamated with another company, and then amalgamated company buys back. There are different permutation combination possible. In different situations, how to compute the amount received by company? So for that, government issued Rule 40BB through CBDT. Rule 40BB covers 11 situations. We will be discussing them briefly. Okay, and then some last part. Okay, now 1st October 2024 onwards, this chapter will no more be applicable. 1034A also will not be applicable. So up to 30th September 2024, what would happen is company would pay buyback tax. Company would pay buyback tax, company will be taxed, shareholder will be exempted. Actually, it is the capital gain of shareholder. So logically, before this chapter was introduced, shareholders were liable to pay capital gains tax with indexation. Company was not liable to pay anything. Thereafter, this chapter was introduced. Now, company will pay at 23.296%. Shareholder will be exempted under 1034A. And now what will happen is, on or after 1st October 2024, if bought back after 1st October 2024, company will not have to pay anything as usual because it is not company's gain. A shareholder will be taxed, but surprisingly, shareholder will not be taxed under the capital gain. Shareholder should be taxed under capital gain, but instead of that, he will be taxed under income from other sources. Entire amount received by shareholder will be deemed as dividend under newly introduced subclause to section 2 clause 22 subclause F. Up till now there were 5 types of deemed dividend, subclause A, B, C, D, E. Now 6th subclause is introduced, subclause F, whereby shareholder will be taxed. So let's try to understand with the help of different illustrations. So practical difficulty will arise only when company is buying back at different rates. 40 clause BB, different situations we are going to discuss. So one after another. First situation, company has allotted original shares. For original shares issued at par, then amount received by company will be equal to amount actually received. We need 2 elements, we need 2 figures, how much company is paying minus how much company had received. Say you had bought the shares from me, I bought it from company at 100 rupee, you later on bought it from me at 500. You bought it at 500, that's okay, but how much company received? Now company is buying back from you, but how much company had received? You did not pay to company, company did not receive 500 from you, company had received 100 rupee from me. So buyback tax will be applicable on 600 rupees. This was creating technical difficulty. Why it was creating technical difficulty or was amounting to double taxation? Because I paid 100 to company, but when I sold shares to you for 500, 500 minus 100 is my cost. On 400 rupees I already paid capital gains tax. That 400 gets taxed in the hands of company once again. That 400 is included in 600. So it was amounting to double taxation. Finally, government took a call to delete this chapter, abolish this from 1st October 24 onwards. Now we just have to discuss various situations under which company, how much company has received can be worked out. First situation is original shares. So consideration paid by company minus amount received by company is equal to distributed income on buyback of shares. Original shares, first situation, company is paying 700, company had received 100, so distributed income will be 600. Second situation, company had issued at premium, 100 rupee face value, company charged 80 rupees premium, company received 180, 700 company is buying back at from the different shareholder, then in such situation distributed income will be 520. Third possibility, company had issued shares at discount. I know that shares cannot be issued at discount, but suppose it is right shares. Okay, 700, say 100 rupee face value, company had issued it for 80 rupees, 20 rupee discount. Then amount deemed to be distributed income will be 620 rupees. Bonus shares. Bonus shares is slightly important, keep it in your mind. 700 companies buying it back for, but for bonus shares company had not received anything. The profits which were capitalized cannot be called as amount received by company. Company has received nothing, and accordingly entire 700 will be distributed income. Right shares, so face value is 100 rupee, but company is offering it at discount of 30 rupee. At 70 rupee company is offering right shares to existing shareholder. Now company bought them back at 700 rupees, then 630 rupee will be the distributed income. 1, 2, 3, 4, 5. 5 were easy situations. Now upcoming 3, 4 situations are a bit complicated. 1, 2, 3, 4, 5 are done. Okay, now the next situation is, what if the company had allotted shares to its own employees under employee stock option scheme? So supposingly P Limited is a company and Mr. Q is an employee of that company. The market value of shares of that company is 100 rupee per share. Company offered the shares to employee at 30% discount. Say you are employee, so we will allow you to purchase at 70 rupees. For outsiders 100 rupee, for you 70 rupee. Employee Mr. Q acquired 1000 shares by paying 70 rupee per share, he paid 70,000. If company P Limited buys back these shares, then technically amount received by company is 70,000, but this is exceptional situation, ESOP, employee stock option plan or employee stock option scheme. Amount received by company will not be 70,000, but amount received by company will be slightly different. Amount received by company will be deemed to be 100 rupee per share, that is FMV, whatever was the FMV at the time of exercising the option. Why is it like this? Reason is, Mr. Q would be taxed instantly under the H salary. Under the H salary, whatever discount that he got, 30 rupee per share, he got this discount because he is an employee. Therefore, this discount will be treated as a perquisite. Under section 17 subsection 2 clause 6, he will be taxed for this perquisite. Amount perquisite value will be difference between FMV, FMV is 100 rupee per share into 1000 shares, minus amount paid by him to receive such shares, 70,000. Accordingly, 30,000 will be benefit, 30,000 is already taxed as perquisite. Now since he is already taxed for this 30,000 rupees, instantly in the same year, this 30,000 should not be taxed again. So tomorrow if he sells these shares for 108 rupees, 108 rupees he sells, for 1000 shares he will get 1,08,000. From 1,08,000, if you consider cost to be 70,000, ultimate selling price is 108, ultimate purchase price was 70. So technically there is a gain of 38,000. However, out of 38,000 is already been taxed for 30,000 under the salary. So now under buyback tax, or if he has to pay himself pay the tax, then capital gain should be 8,000, and if company has to pay buyback tax, company should be paying tax on 8,000. That is how 30,000 already taxed under the salary and 8,000 will now be taxed either in the hands of company under buyback tax, or after 1st October 2024 he himself will pay tax on 8,000 under capital gain head. So that total profit is 38,000. Are you all following this? Right? So conceptually he is already taxed for 30,000 under the head salary. So now amount deemed to be received by company will be 1 lakh. So that company is paying him 108, that is 1,08,000 minus company had received from him not 70,000, company had received from him 1 lakh. So that difference is 8,000. If you consider 70,000 here, the actual amount received by company, then the answer will be 38,000. Out of 38,000, 30,000 is already taxed under the salary. Okay. So it is an exceptional situation, therefore covered by rule 40BB, clarifying it to us that don't take 70,000 as amount received by company, take 1 lakh rupee. So amount which company will be deemed to have received will be FMV at the time of exercising the option 100 rupee per share 1000. So what will happen is, if company is buying it back ESOP shares for 700 and company had received 70 rupee per share, but we will consider it as 100 rupee, accordingly distributed income will be 600 rupees. Okay, next situation is about amalgamation, which is also interesting situation. Supposingly you bought shares of X Limited 1000 shares at 300 per share, total you paid 3 lakh rupees. So company received, you bought it directly from company, so amount received by company from you is 3 lakh rupees in totality or 300 rupees per share. However, ideally we should not pick up the figure per share because quantity may differ. Okay, now tomorrow this company amalgamates with Y Limited and they form a new company XY Limited. So as a result of amalgamation, this company will be shut down and the shares of this amalgamating company will also stand cancelled. However, this does not mean Mr. X assessee will lose his 3 lakh rupees. In place of his 1000 shares of old company, amalgamating company, he will be allotted shares of new company free of cost. Maybe same quantity, maybe different quantity. Here I am taking example with different quantity. For 1000 shares of amalgamating company, he is being allotted 600 shares of new company. Then how much this company will be deemed to have received? If shares are bought back by X Limited only before demerger, then amount deemed to be received is 300 per share or 3 lakh in totality. But if the shares are bought back after amalgamation, bought back by amalgamated company, then amalgamated company will not be deemed to have received 0 rupees. Amalgamated company will be deemed to have received the same amount which earlier company, amalgamating company, had received. But how much earlier company had received? So we will not consider share wise or per share value because quantity is different, 1000 shares, 600 shares. The amount this company will be deemed to, amalgamated company will be deemed to have received will be 3 lakh rupees in totality. And if you want to find out per share, then divided by 600 shares, amount will be 500 rupee per share. 500 per share. And this company 300 per share, new company 500 per share because quantity is less. Whichever company is buying back, accordingly you will take a call. So if bought back, so this company would be deemed to have received not 0, but would be deemed to have received 3 lakh rupees in totality divided by 600 shares, 500 per share will be deemed to have been received. So if bought back by X Limited, that is before demerger, for 700, then amount received by amalgamating company was 300, then distributed income will be 400. If bought back by amalgamated company XY Limited for 700, then they had received or they would be deemed to have received 500 rupee per share and not 0. Accordingly, distributed income will be 200 per share. Okay. Next is demerger, opposite of amalgamation. Now, for example, there is this company called ABC Limited. You bought 1000 shares of this company for 300 rupee per share. So your investment is 3 lakh rupees. Now this company had 3 different divisions, division A, division B, division C. They decided to demerge division C or undertaking C and create a new company called C Limited. Old company will continue, will be called as demerged company after demerger. New company C Limited will be called as resulting company after demerger. ABC Limited is D company, demerged company before demerger. This is demerged company after demerger. Prior to demerger, what was the position on net worth? Net worth means assets minus liability. Old company had got 1000 crore worth of assets. Assets worth 1000 crore and liability worth 600 crore. Accordingly, net worth of this company was, before demerger, net worth was 600 crore. Out of 600 crore, they decided to retain assets worth 600 crore. Out of 1000 crore, 600 crore worth of assets are retained by old company, demerged company, 400 crore worth of assets they handed over to new company. And from liability of 400 crore, they retained liability worth 200 crore, 50-50, and 200 crore worth of liability is handed over to new company. What will be the net worth of resulting company now and demerged company now? Demerged company net worth will be 600 minus 200, 400 crore, and for resulting company it will be 200 crore, that is 400 minus 200. Now these 1000 original shares of demerged company ABC Limited continues. These are same 1000 shares which were bought originally, 1000 shares, but the market value will reduce. Market value of though 1000 shares quantity wise they continue, but the market value will not remain same. If you can see what percentage of assets are transferred, 2/3 assets are retained and 1/3 assets are transferred to this new company. Net assets to be seen, not gross assets. So don't see 1000 crore worth of assets, out of that 600 crore are retained by old company and 400 crore worth of assets are handed over to new company. This is gross ratio, gross asset ratio, 600 is to 400. But we have to consider net of liability. Net of liability it is 400 crore, that is 2 is to 1, 200 crore. 4 is to 2 or 2 is to 1. In this ratio assets are distributed, net assets are distributed. So 2 is to 1 is called as a net asset ratio. Then the 3 lakh rupees, the original investment, will also be split between the two companies in the same ratio, 2 is to 1. So value of the share, amount deemed to have been received by company from D Limited, from ABC Limited will be 2 lakhs, and resulting company amount deemed to be received will be 1 lakh. Though it is 3 lakh here and 0 here, then also it will not be 0, it will be 1 lakh, and here original 3 lakh will not be 3 lakh, will be deemed to be 2 lakh rupees. However, we don't have to split in the 2 is to 1 ratio straight away. There is a formula given, you need to follow that formula. If the question comes in the form of MCQ, then you can straight away follow this shortcut and divide original 3 lakh rupees into two parts in the ratio of net assets retained by demerged company and net assets transferred to demerged company. Simply net assets ratio. So how to find out net assets ratio? The answer, how much was the net worth of the company before demerger? Net worth was 600 crore. 600 crore. Out of 600 crore, how much net worth is transferred to resulting company? 200 crore, which is 1/3. So 1/3, so 1000 shares into 300 per shares. First you find out how much was original amount received by earlier company. Amount received by ABC Limited before demerger was 3 lakh. 3 lakh into 200 crore divided by this 600 crore. 3 lakh into 200 divided by 600 is equal to 1 lakh rupee. Company will be deemed to have received 1 lakh rupee. If you want to find out how much per share, 1 lakh is in totality, per share then divided by number of shares allotted. Accordingly, 250 rupee per share will be deemed to have been received by resulting company. This is the story in the hands of resulting company. What will happen in the hands of demerged company? In the hands of demerged company also we should follow the same formula, but don't follow the formula. Here shortcut is provided. Original amount received 3 lakh rupees minus amount deemed to have been received by this company 1 lakh. So balance 2 lakh will be deemed to be the amount received by ABC Limited from the shareholder, and if you want to find out per share, this is in totality divided by 1000 shares, then it will be 200 rupee per share. Ideally you should never calculate per share, because per share calculation can be applied if the quantity is same, 1000 shares here, 1000 shares here, then it's okay. But if the quantity is different, then you need to calculate not per share wise but in totality. In totality 2 lakh is received by this company, and in totality 1 lakh is deemed to be received by this company. Per share you can find out separately. So it will be 200 per share by demerged company deemed to have received, and 250 per share will be deemed to have been received by resulting company. So in case if bought back by demerged company ABC Limited after demerger for 700 rupees, then company will be deemed to have received 200 per share, and accordingly 500 rupee per share will be the distributed income, on which 23.296% tax will be payable. And in case bought back by resulting company after demerger for 700 rupee per share, company will be deemed to have received 250 per share. Accordingly, the distributed income will be 450 per share. Multiplied by quantity, you can always multiply later. Okay, last situation, which has two parts. If originally acquired are not shares, company received 3 lakh rupees or let's say 1 lakh rupee from shareholder, but what was originally issued was convertible debentures. X Limited, you are the assessee, you acquired 1000 debentures, company allotted you 1000 debentures for 1 lakh rupee, that is 100 rupee per debenture. Now these debentures got converted into 200 equity shares, then amount deemed to be received by company will not be zero, these are allotted for free. But amount deemed to be received by company will not be zero, will be same as whatever company had received for allotting debentures. Here also everything to be computed in totality, amount wise, 1 lakh rupee. Never calculate per share, unless per share calculation you should do later. Meaning thereby, here per debenture company had received 100 rupee. You cannot simply say amount received by company for issuing shares will be same as amount received by company for debentures. Agreed, but then you cannot take 100 rupee per share because quantity is different. Here 1000 debentures, now 200 shares. So calculation will have to be made in totality for entire 1 lakh. Company will be deemed to have received 1 lakh rupee. If you want to find out per share, then you divide it by 200 shares, and accordingly per share you will get 500 rupees. Company will be deemed to have received 1 lakh in totality for 200 shares or 500 per share by dividing it by 200. However, these were the debentures which were fully convertible. What if they are partly convertible? That means PCD, partly convertible into shares and partly redeemable for cash. So, Y Limited 1000 debentures are acquired for 1 lakh rupee, that is 100 rupee per debenture. 40% is redeemable for cash, that means 40% of what amount? Say debentures are for 10 years, tenure is 10 years, during 10 years company will keep paying interest. Now at the end company will not buy or company will not redeem the debentures for premium, company will pay whatever company had received. Company had received 1 lakh for 100% debentures, 40% is redeemable for cash, company will pay 40,000. 60% balance are convertible into 300 equity shares, then amount deemed to be received by company for these 300 shares will not be zero, will not even be same as 1 lakh, will be proportionate cost, that is 60% of the cost of debenture, so, or 60% of what company had received for allotting debenture. It will be 60% of 1 lakh rupees. Accordingly, company will be deemed to have received 60,000 rupees. Always calculate in totality, don't calculate per share. Later on we can calculate divided by 300 shares, company will be deemed to have received 200 rupee per share. Right now calculate in totality. Per share it will be 200 rupees. That's it. With that this chapter comes to an end. On or after 1st October we have discussed all the situation. Last note, this chapter is also deleted from 1st October 2024 along with 1034A exemption with effect from 1st October 24. With effect from 1st October 2024, what will happen? So answer, section 2 clause 22 subclause F will be applicable, whereby this entire amount paid by company 700 rupee per share or whatever, entire amount for shareholder will be deemed to be dividend under section 2 clause 22 subclause F, entire amount. And in capital gain chapter section 46A will apply. Under the capital gain chapter, sale consideration will be nil. As per 46A section, shareholder will be deemed to have transferred his shares. Without indexation, you can subtract cost of acquisition. Cost of acquisition is, let's say, 200 rupees, which will result into per share, which will result into short term or long term capital loss. short term capital loss or long term capital loss depending upon period of holding and depending upon whether private company or public company. 200 rupee per share will be the loss which assessee can carry forward to the next year, and whatever is received from company will be entirely be deemed to be dividend, and dividend will be taxed as per slab rates. Pay tax on 700 rupees entirely, and cost of acquisition you claim as deduction under the head capital gain by considering sale consideration to be 0. So under the head capital gain there will be 200 of loss, and under the head IFOS 700 per share will be taxed. These two cannot be set off against each other for a simple reason. Capital loss can be set off only against capital gain, homogeneous loss. Capital loss cannot be set off against other heads of income. Therefore, assessee will be compelled to pay tax on full 700, deeming it as dividend under 222F newly introduced. And in capital gain chapter he will have a loss, which if he has capital gain from other income, other assets, if he has capital gain then he can set off this loss, otherwise he can carry forward for 8 years and try to claim set off in the future years. That's it. With that this chapter comes to an end. Question can come in the form of MCQ depending on the date you have to answer. That's it. See you in the next video with the next chapter.